Okay, folks, welcome back. This is our weekend review for week ending July 26th, 2019. All right, so we have the economic calendar in front of us. On Monday, there's an absence of any economic drivers. On Tuesday, we have German preliminary CPI all day. 8:30 a.m., news embargo lists, medium impact core, PCE price index, and personal spending. And at 10 a.m., we have consumer confidence for the dollar, high impact. On Wednesday, for London Open, we have Spanish flash GDP, CPI flash estimate, and core CPI estimate. 8:15 a.m., we have non-farm employment change, high impact for the dollar. 8:30 a.m., news embargo lifts, we have medium impact employment cost index. At 9:45, we have Chicago PMI. And the big one for Wednesday and for the week is 2 p.m. FOMC statement, federal funds rate, and press conference at 2:30. Lots of volatility expected around Wednesday and Thursday, because on Thursday, London Open, we have manufacturing PMI, medium impact for GBP. 7 a.m., GBP, Bank of England, inflation report, and official bank rate votes, and monetary policy summary with the official bank rate. Asset purchase facility and asset purchase facility votes, medium impact for GBP. Then at 7:30 a.m., Bank of England, Carney speaks. Then at 10 a.m., we have manufacturing PMI for the dollar, which is high impact. Wednesday and Thursday are going to be extremely volatile, which takes us right into non-farm payroll Friday. Average hourly earnings, non-farm employment change, employment rate, high impact 8:30 a.m., and then revised consumer sentiment, medium impact at 10 a.m. on Friday. So what does that mean for us? Okay, obviously there shouldn't be anything in the way of what has started in motion this past week on Monday. And then on Tuesday, we really don't see anything that would upset, I don't think personally, the underlying conditions that's technically unfolding, as we'll talk about when we get into the charts. On Tuesday until 10 a.m., that might change a little bit because of the consumer confidence. On Wednesday, do not trade. On Thursday, do not trade. On Friday, do not trade. Unless you have something from this previous week, like I have a short on from Euro Thursday. Unless you get something on Monday or Tuesday early on, and you've taken something off, and you have basically a partial on, do not assume a new position, even in your demo. Okay, so I really shouldn't have to say it like that, but I know some of you are just really pushing the live funds entry. Okay, we don't do that here because you have to learn a lot before you actually trade with live funds. But nonetheless, there is so much ahead in this economic calendar that could really, really hurt you. So be respectful of that. That was the reason why I tweeted next week's challenge was to stay solvent. That means to stay in a condition where you can participate, if you will. So if we have something obviously rolling over into next week, we want to see if we can get these objectives that I'll outline in a moment. Otherwise, Monday shouldn't be any impediment, but there's going to be a lot of rush to get to some measure of profitability Monday and Tuesday because of the Wednesday, Thursday, Friday economic calendar. So professionals will have a short week this week, and we will simply be looking to take caution going forward for this particular trading week, okay? Be mindful also, the expectations should be very, 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 very low in my commentary for this coming Wednesday. So as a result, I will provide more teaching in the midweek Wednesday review than jawboning too much about the technicals, because I don't want to give the impression that there's something of high probability with this economic calendar, because it's not. Okay? So let's take a look at the economic calendar and see what's going on in the price charts. Okay, folks, we're looking at the dollar index. This is our daily chart. And I'm kind of want to talk a little bit about how the you're supposed to be going through the mentorship and applying the content, because I know some of you are new and some of you have gone through the mentorship for a couple months now also, and you have a lot of information coming at you and you want to know what it is that you're supposed to be doing with it. Okay, you should be studying it, obviously, and then when I give you my perspective each week on Wednesday and on the end of the week, like we have right now, weekend edition, I want you to concentrate on what I'm suggesting where price may go. Okay, now, as I described the mentorship for all enrollments, this is not a signal service, but it will teach you how to find setups. It'll obviously tell you where the market's going, because we do that every week here. What I want you to do is take the information I give you from the topical studies, from the core content, in other words, the lessons that I teach you in all the monthly content you purchase. If you are a charter member, it's important for you to go back through it again. Every year you should be cycling through it. It's so much content. You're not going to know it all. You're not going to remember it all just one or two times. You constantly revisit it, because what will happen is when I'm doing review videos or I'll talk about something, okay, that moment of where you have that epiphany, that moment where it clicks for you. Something that you've been struggling with will fall right into place. That is only going to happen if you are taking the initiative and studying the actual core content lessons. They are fragmented. Okay, they're little components to the larger machine. Okay, imagine a little gear. Okay, every one of those little conceptual lessons are a gear in the big machine that is ICT. So everything that makes me think about the market in a specific manner, everything that allows me to internalize the markets and visualize what should happen before it happens, I've given you the foundation in the core content. Your job is to take that information and slowly flesh out your understanding and where those things are occurring in the price action that I'm talking about. Now, I purposely leave out a ton of insights from the reviews on Wednesday and the weekend review. Now, right away, that's going to sound like, oh, see, you're not really teaching us everything, Michael. You're holding back information. I had this a lot from the first group. That some of those members since left, but nonetheless, the idea is for you to take the information I've given and plug those pieces conceptually in the context. And I'll give you an example of what I mean by that in the review here. But you're supposed to be going through every single day and seeing where these things fit. By doing that, it forces homework study, it forces price action study, and it forces perspective in the proper context. Remember, think of the analogy as a sniper. I am your scout. In other words, I'm spotting for you. I'm looking, finding the targets for you, and I'm saying, okay, the wind is blowing this fast from this direction. You need to compensate. Your mark is 100 yards away. You need to set your scope, dial in on what it is that you need to calibrate. As the sniper, you're the one taking the shot. In other words, I'm pointing, you're shooting. You're not going to hit everything the first time. In fact, you're not going to hit it at all in the beginning, but you're going to understand a whole lot because I'm walking you through it every single week. Now, the folks that come in and they want handouts, they want me to tell them exactly what to do every single time they sit down in front of a video, you're going to be very frustrated with me because you're not going to learn that way. And also, I'm not spoon feeding those individuals that want to do a signal service or an analysis service and then parrot everything I tell them in the mentorship. So it's important for you to understand why I teach the way I do and also the reasons why I do the analysis the way I do. We have a great deal of accuracy throughout the weeks. If you go back and look at the archive, especially the new folks that are here, you'll see that we're pretty much right just about every single week. Now, that goes that goes against what everyone else talks about in analysis. They say that it's hit or miss. There really isn't any way of knowing what the market's going to do. You can't time the market. That's all nonsense. But I want to kind of have that in mind when we're doing the review today, because I want you to think about just month one content. Okay? Think about month one content. Because what I'm going to talk about here, I purposely, when I designed this mentorship program, okay, I sat down angry because folks were selling my free content. I came back from a vacation. I go online and people were sending me emails saying, hey, this guy's selling your free videos. And that was it. It's something inside me snapped. I didn't say anything. I immediately sat down. I said, okay, if I want to formally try to instruct people, what's the first thing I want to do? I want to teach them immediately how to go into the charts and find setups. That's what I started with month one. But I understand some of you don't fully appreciate it because you don't really understand what you've been shown, because you haven't practiced with it. You haven't studied it. You haven't used the information. If you have not really gone through month one's content, this is that reminder to do so. Okay? I don't care where you are in the mentorship, if you're a charter member, even from the 2017 group. I promise you, if you go back and go through that first month's content lessons, pour through that, and then think about what I tell you every single time we do a market review. I'm giving you all of the internal dynamics of why the markets should be doing what it's going to do and why it should not do what it won't do. Now, I'm not 100%. You've seen a couple times where I wasn't right, okay? But for the most part, I am right. And I'm not trying to convey the idea that you should be focusing on being right. I'm just stating as a fact, and just go back and look at everything's recorded. Okay, I can't go back and change what you watch. These things repeat themselves over and over and over again. If it was not algorithmic, it would not have continuity. It wouldn't repeat itself. Okay? The things I point your attention to in the videos, that is what you're supposed to be using as your context. Do not try to arm wrestle me. Don't try to think beyond what I'm trying to talk about. Don't try to assume that there's this carrot dangling in front of you. Don't do this, but don't do this. In other words, I'm not trying to trick you in anything. I want you to learn, but the only way you're going to really learn this is if you roll your sleeves up and do what I'm going to talk about now, okay? So just be mindful that I don't need to do these reviews, okay? I don't need to do it. You have been taught how to do it in the mentorship. I do it as an aid, as an assistance to you, okay? I could literally sit down and do this every single day, but I don't have the time to do it. So I give you a midweek review, kind of reminding you where we are, or sometimes I'm waiting for something to happen and then we get an opportunity like we did last week. If at some point, and I don't know when that will be, I get overwhelmed with the amount of work that is involved with this, and it's a lot of work right now, it'll probably drop down to 1 week's video. Now, that may mean that sometimes we'll have to wait until something changes in the analysis, or we just work off the weekly review like on the weekend. Now, don't get your feathers all ruffled. Oh, no, don't do that. I'm just saying, if it ever becomes too much, that's what I would do. I would always still come back and say, hey, look, this is what we're focusing on for this week. But doing these videos takes a lot of time, and I don't want to stop, and I don't want to also just ignore the possibility of it becoming too much to do 2 of them a week. So just, I'm not nowhere near that right now. But because there's no length of time to this mentorship, and I'm not saying, we're going to be doing this for 12 more months and I'm stopping or anything like that. I'm saying because it's open-ended, you pay to be here for me to be able to tell you what I'm thinking and continue teaching. But just remind yourself also that these are just moments for me to stir up your interest in what's going on and where your focus should be at. Okay. Last week, Aussie dollar was moving around, dollar CAD was moving around, but I purposely kept your attention on these two pairs, euro and cable. Now, it's important because it forces you to remember all these instances where the highly critical folks that are in here, and you know who you are, you will say to yourself, oh, well, he missed Aussie dollar. And oh, yeah, he missed dollar CAD. If I want to trade those pairs, I can find setups in them. I'm not worried about missing anything. My role is to teach you. And because there's always going to be opportunities, there's things happening in the S&P. S&P was an easy buy last week. Guess what? I didn't trade it. The bond market's moving around. Other currencies are moving around. Okay, look at Bitcoin, for instance. It moves somewhere. I don't know what it's doing right now, but I'm not trading it because I don't feel the rush or need to be in it. You have to settle in on a opportunity when it presents itself, and because you can't trade every market out there, I'm forcing you to understand that there's no reason for you to feel like you're missing something. If you reduce your visibility down to one or two markets that are closely correlated, like we do here in the mentorship, I do not force you to trade just these two pairs. Some of the newer students have sent me emails asking, why can't we trade other pairs? You can trade any pair you want when you know how to trade. Right now, as a student, the assumption is on my part, you don't know how to trade. Otherwise, you would have never sent me any money to be listening to these videos anyway. So know that the concepts that I'm teaching you with these two pairs, the number one reason why is because these are the two primary pairs that I follow. I only look for setups on these every single week. And they're consistently delivering pips. So I don't need to be chasing anything else. Also, it's not going to drive me crazy like the first year's group did. I tried to give everybody what they wanted. It was like, have it your way, Forex mentorship. Okay, I'm sorry, but I'm not the Burger King. Okay, I can't just have it your way, whatever you want. I'm going to do it for you. It drove me nuts. Okay, it literally drove me nuts, and I couldn't keep up with everyone's wishes, and I didn't do very well, I didn't really do a good job because of that. Now, you can say that's excuse making, you can whatever you want to call it, but I'm telling you, I'm human, okay? And I can't have 830 some people asking me all for different things at the same time and be able to deliver that. It's nobody can do that. Nobody can, okay? So the mentorship has morphed into this. So we do this for a reason because it's going to teach you. Everything that's shown in euro dollar and British pound versus the dollar is always going to be the same type of thing in other foreign currencies, in every other market too, because it's price action. That's what we teach here. So it's important also to remind yourself that you don't need to have 28 pairs. You don't need all that. I could literally just strip this down to just trading euro dollar, even as tight as the range has been for euro dollar. I know what I'm looking for. I know when it's going to likely to occur. And that's the importance of learning from someone that has been doing it for a long time. That's experience that you can't glean from a book. You can't get it from watching somebody's videos on YouTube. You have to live with them. And that's what you paid for. You're with me every single day. If there's something I'm interested in, I'll talk about it through the forum. If there's something that's interesting for me for the week, you'll know about it Wednesday or the weekend before it happens. So just keep that in context when we go through this video, because your job is to slowly put things in place before I start talking about it in 2020 for these specific trading plans. Once you're in charter membership, 2020, we'll take those 12 price action models and drill down very, very tight, definitive, binary thought process. If it does this, then I will do that. If it doesn't do that, then I won't do this. That type of thought process. So just be mindful that we have to weigh everything in the proper context. And that's all I try to do on the midweek and the weekend reviews, is to provide that context that you don't have right now. You don't have the experience. So I'm lending my experience to you in the only way it can be done, before the fact. Okay? And I'm not giving signals. I'm not going to help anybody trade their accounts, so please don't send me those emails anymore. Okay? And I'm not doing trade copy or things, something like that. So, I appreciate your interest in all that, but I don't do that. All right, so now let's get on with it. It's been 15 minutes of jawboning, but it's important. So, again, if you weren't paying attention the first couple of minutes of this video, you were washing dishes and your iPad's playing next to you or whatever, go and listen to me again, because it's really important that you have that mindset going forward. Not just in this video, but can apply it to every other video you've ever heard me talk about, because it's important. All right, so we have the dollar index. Now, I'm going to counsel you to go back and refer to your notes. What notes? Yeah, last Wednesday. The things I talk about, the conditions I specifically talk about. I believe it's going to do this, or I don't believe it's going to do that. Okay, or I'm expecting this to be a factor, or this not to be such a factor. Okay, whenever I'm giving things like that in my commentary, it's really important for you to write those things down. And if you can, look at the time in the video where I state it, because that way, when we do our weekly reviews like now, you should have already revisited that and also seen it in your notes, because it helps you stay motivated. It's very easy to think about how watching these videos, learning these lessons, and you're not making money right now. Okay, there's so many people in here, even in the first group, that are saying, I have to make money. I need to make money. No, you don't need to make money. You don't need to make money trading. You need to know what you're doing in price, and that will give you the means to see profits follow the process. But you're not going to make money, even if you watch videos all the time, over and over and over again. That doesn't translate into success. You have to practice, and you have to endure going through it, even when you don't want to. Okay? And the way you stay motivated is to go back and listen to me talk about specific things, and then look at the price action, and you'll see the things I'm talking about are not in the charts yet. Okay? Then they form, and then they do whatever I say they're going to do. Now, you can look at that and be frustrated and say, okay, well, why don't you just give me trades? And that takes us right back to, in this mentorship, I teach you how to run your own signal service if you want to. But I'm not going to be the sugar daddy giving you the trades, because everybody would do that. Think about it. If I'm throwing out 90% stats where it's hitting every single week, it's real easy to make a lot of money doing that. You won't trade. You'll just do that. You'll parrot whatever I say. You'll never worry about what I'm teaching you. You'll just be in the business of parroting whatever I tell you. And that's why I don't do it. So, on Wednesday, I said that we had this dealing range from the high to the low here. In the low end of that range, we had this order block. This has since proven itself as a reclaimed order block. What makes it a reclaimed order block is the fact that we came down, we had the movement displacement here. Price came back down again, tagged it one more time, and then we had the market trade higher. Here's Friday, Thursday, and Wednesday. In this day here, we had price move outside of the range. Remember, I stated that we wanted to see price trade outside of the range, and we did not care. We did not care if it was above this high or below this low. I didn't care. Now, why did I feel comfortable and confident enough to say, okay, I think we've now made an attempt to get out above this high, proper context was it still can fail and go lower, but I didn't think it would. I said that the limit on how much it would retrace would be the equilibrium. I stated that we should not even trade back below this high, but if it does, there's your point at which it should not breach. Okay, I taught you how to use the equilibrium inside of a dealing range. I talked about the volume imbalance here. We had a SIBI here, and then we have the buy-side liquidity pool up here. So now we have a defined dealing range. I gave you the parameters for that dealing range, the unrealized dealing range. In other words, the range at which the trading market will work within in the future. Go back and listen to my analysis on Wednesday's video. I gave you all these factors. So if we know that this high here should be support, in other words, it shouldn't go below that, and we have a volume imbalance here. Watch what happens when we know this. Here's our fib. Okay, from this high up to the volume imbalance, right there. Assuming it fills it all the way up in here where the bodies are missing, it's just wicks. That little segment of price action is what I refer to as a volume imbalance. The market will want to go back up in there one more time and fill that in. It may do so with a wick, but more importantly, I like to see a body exist in that range. We didn't get that until Friday. Notice that. So now what we have here is a dealing range that is unrealized. This is where you write down in your notepad, okay, because I have not talked about this before, because it's all part of 2020 content. It's algorithmic, okay, but I kind of like want to satisfy the insatiable desire that some of you have, because I know some of you are already contemplating you don't want to stick with it because it's too much work. Okay, it's too many lessons to get to a condition or a destination of unknown, and I might not like where I go anyway, so I might as well just quit now. I know that's what some of you are thinking, but I want you to think about it like this. This is what you're supposed to be doing with the content. Every time you get new content each month, you start building in all these things, and you see where these things apply in the market moves, because I'm not going to pull them all out in the review. I'm not going to do that, because that's the part that you're supposed to be doing. That's the homework. That's the study portion, okay? And I'm not going back and telling you should have saw this and this and this, because again, I would be doing it for you. So this lesson, I'm doing the very things that I don't do in the reviews, but you'll see what you're supposed to be doing, okay? But just be reminded that I said these things Wednesday, period. Then it happened, all right? So we have our dealing range. It's unrealized dealing range. Again, an unrealized dealing range is a measure of price range that we anticipate price moving up to or down to. In this range, you'll learn about a concept called grading price swings. I'm not going to teach that here because it's a lesson taught in the mentorship core content, but this is an unrealized dealing range. When price breaks out here, I don't care that it was going to go above here or below here. I just needed it to do one or the other. Because if we broke below here, I already told you where my discount arrays are that I'm interested in. Those would all be targets. If we go above this high, then I'm going to be looking for the buy side liquidity above this high here, the volume imbalance here, the SIBI here, sell side imbalance, buy side inefficiency, then the buy side liquidity pool. I just mapped out every salient PD array in the daily chart using the PD array matrix. And you'll learn about that. Month one content. Remember I told you to think about that? I said, when you have an area like this is an unrealized dealing range. We want to be buying high probability conditions below the 50% level. Now, if this is where we think price may go initially, and that's all this is an initial unrealized dealing range. Now, you're not finding that in books, you're not finding that in Chris Lurie, and this is no knock against him, but I had a guy on Twitter this morning tweet saying, I believe I have a theory that everything that ICT teaches, all his concepts are Chris Lurie. Now, Chris Lurie, I have a lot of respect for that guy. We've had a lot of conversations on the phone. We did webinars together. I've told people many times, go and check his stuff out, because if you're a new trader, you don't know what you're doing, his is actually a good foundation to start with, because it helps you understand certain aspects about price action. I don't subscribe to everything he talks about, but for the most part, a lot of things, it's good for a starting point. This isn't Chris Laurie stuff, okay? But just know that we have a range in here. Above the 50 level is not high probability. That's a premium range. At 50 or below, that's a discount range. Now, that means in this area, your thought process should be, whenever I'm talking like this, when I'm calling out certain points in price action, this is the type of stuff you're supposed to be doing, because I taught it to you in month 1 content. You have zero excuses. You have no way to come back and tweet, well, I didn't see it like that, because I told it to you in month 1. It's there. I hit the ground running right away, giving you an opportunity to find setups as soon as you start going into the charts. I wanted something that would deliver immediate feedback in price action, so there's no way that you could say, I don't like this, I'm going to quit. Only the weak quit. And I had a lot of people quit the first month because it wasn't feeding them that little sugar, that little cookie. Here, you gave me 150 back then, okay, and then I'm going to give you a trade. No. I'm teaching you how to make as much money as you want to make. And you could do that just from month 1 content. Period. Mic drop. It's as simple as that. Because what I'm showing you here is exactly right out of month 1 content. I said that we have a volume balance. I think it's going to go up there. I also said that the buy-side liquidity pool, I think that's the draw. And we also have a SIBI, sell-side imbalance, buy-side inefficiency, and a buy-side liquidity pool here. This level, down to this old high, anything that occurs in this range here is a high probability setup. Now, right away, think in terms of trading plan, fleshing out how the step-by-step process. This is for you, Larry. I need to know. I need to know what's the root of all decision making, and I have to have an EA to do it. You don't need an EA, by the way, Larry. In fact, you don't really want an EA. Trust me, you don't want that, because you have to be able to have some measure of accountability. And if an EA is doing all the thought process, you can't really program an EA as precise as would be needed in all the things I teach, because there's so many variables. It only comes by way of experience. And that's the reason why, believe me, I've had a lot of people try to program things for me. I spent fortunes to try to get certain things programmed, and it just became silly to even think about it. Now, you can program certain aspects, like you can create central bank dealers range indicators, flout, and all this other business. But there's so many. Like, how are you going to teach the algorithm to see the volume imbalance, the buy-side liquidity pool, the SIBI, and the buy-side liquidity pool, and also to evaluate which one has the higher probability? I came from computer programming, and I have a lot of math behind me as well. And I can tell you, it's next to impossible, okay? Because there's so many factors in here. An economic calendar too. Like, you got to look at the economic calendar. How are you going to program all that? You see why I don't have everything click and button and it's all done for you? That lazy approach stuff, it doesn't work here. So, knowing what you're supposed to be looking for, it starts here. Now, what I just gave you is what 90% of every free level member student that I have that watches all the tutorials and like Sniper Seers and all other business, they think they understand order blocks, they think they understand optimal trade entries and breakers and all that business. They're just pieces. Okay? If they just got what I just said right now, things would start firing off in their brain. They would see things that they're not seeing right now. Now, some of you may say, oh, that's cruel. Why are you leaving them like that? I'm not obligated to teach them. I wasn't obligated to teach any of it at all, ever. It was a social experiment for me, and also to provide things for my kids. Now, they have full renditions of videos and notes, and they also have access to this as well. But I wanted to see if anybody would learn it the way I was, and nobody was doing it. So I'm reminding you all that this factor, which was taught to you in month 1 content, this is that missing element that people are not catching when they use order blocks, breakers, optimal trade entries. This is the part they're missing. Because the algorithm works from premium to discount, discount to premium, premium to discount, discount to premium, back and forth all the time. Okay? You have to wait for price to show displacement. That's what I told you all to wait for. And I basically said, look, there's really nothing to talk about. The previous recording prior to last Wednesday's teaching. Then Wednesday came. I said, okay, here we got it. We got to move above this high. So now IPTA should expand and seek the liquidity above here. Volume imbalance, SIBI, buy side liquidity pool. And not breach this level. The reason, again, why I felt the dollar was bullish was we worked outside of the dealing range on the upside. Okay? Once that happens, we don't just indiscriminately go in there and say, okay, well, hey, we broke out. We're a buyer now. No, we're not doing that. Breakout artists would say, okay, we have a bullish candle here. Okay, so now I'm going to buy above this high here. If it does that, we'll buy it. Well, they bought it here, and then sit in this, and then sit in this, and probably got stopped out. And the support and resistance guys never got a fill because it never traded back down into that old high. You see how that's a farce? It's nonsense. All those things in those books are meant to steer you in the other direction. And you're going to get frustrated. But there'll be 4 or 5 examples in the books to talk about how it worked. But they didn't take those trades. They didn't call those moves before it happened. They're writing a book about something that's already happened. I'm giving you the future every single week. Now, I want you to really understand that. Because if you haven't really fully grasped that yet, you need to today. Because looking at the chart, we have a range in here. Now, this looks like a demand zone because it's a rectangle on my chart. Now, obviously, this wouldn't be viewed by the supply and demand folks right away as such, but anyone familiar with it would look at that and say, oh, that's that supply and demand stuff. No, it's not. All right, so we're going to drop down in. Okay, and mind you that these levels are going to show up on the lower time frame. Okay, this is the closing price for Friday. That's not the level we're talking about, but the volume imbalance here and this level here, which I admittedly didn't bring up, but you should know about it. This candle here, this candle here, this candle here, and this candle here. All 4 of those candles make up what? See, you knew. That's a bearish order block. Now, does it mean the market's going to hit it and go lower? No. That's where they sold. As price rallied up, they sold it, and then we had distribution on the downside. So we take this entire range of 4 candles, up, close, consecutive, bullish candles, and you divide that entire range in half, and you get this level right here, which is the mean threshold. So there is another premium array here. So I apologize. I was a little overzealous about getting to the heart of what you just heard me really just stand on my soapbox and tell you. Buy side liquidity pool, volume imbalance here, mean threshold of the bearish order block, SIBI, rejection block, buy side liquidity pool. Okay, that is the full spectrum of the daily PD array matrix. All of those would be targets, but we deal with the initial one first because this is enough of a range to make money on. You may not think so, but I could do a ton in this, as I'll show you. So we have this range here, and just note that the top of the shaded blue area that makes this rectangle is, again, the 50% level. So everything below the top of the rectangle down is high probability bullish scenario. We are in a discount market because we have an unrealized dealing range. We're expecting the market to go where? This is the draw on liquidity, the volume imbalance, the buy side liquidity pool here. Okay. Notice that the 50% level is lower than the high on this candle. It's still a discount. Up to this level is above this high here. So obviously we start projecting further into time with higher premium arrays. Now you'll learn about premium arrays in month 5, but again, just know that everything I'm talking about here is conceptualized in month 1 content. So I'm going to drop down into an hourly chart, and we will do so and zoom out. Okay, so here's that rectangle, an unrealized dealing range up to the volume imbalance. Okay, best case scenario would be to this level here, and we just hit the bottom level of it here twice, created equal highs. But I want you to look inside this rectangle here, right in here. What do you see there? You see anything important? Anything noteworthy? You want to know where setups are, where they form, how they form, why are they forming? That's what you're learning here. Okay, so for trading plan purposes, when you want to build a trading model and flesh it out with specific parameters, I gave you the go-to method to find out where those formations are going to occur. Okay, so from this price level, which we'll put a horizontal line on, there we go. From that level here, that's really not dark, is it? Let's darken that up. Make it a little bit thicker too, so we can really see it. It'll pop on the chart. All right, so now we can really see that level right there. Okay, so anything below this level constitutes a discount market. That means the market's being driven down there to allow bank traders to accumulate long positions. This is all IPTA does. That's all it is. Okay? It's a means of facilitating price delivery so the traders that know about it can enter. All right? So the Anton Creel kind of guys, the guys that say, I'm a former ex-bank trader, blah, 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 they don't know this. That's not what I'm talking about. I'm talking about the upper tier bank traders that are really not talked about. You don't see them. You're never going to meet these folks, okay? They're not worried about sharing the MyFX book. They're not worried about teaching people. They don't want you knowing these things, okay? IPTA is the algorithm behind allowing those folks that are they're employed to engage and participate in these environments for the purpose of profiting for the bank. That's it. You can argue with that. You can not want to believe it. Whatever. It doesn't change it. Okay? So, inside of this range here, your eye needs to go to the lowest point of PD array. That means we have a rejection block that's just outside of the range. Could we use that? No. It's outside the scope. It's below that level. 97.17.5 was the specific level. This close, this rejection block, is not going to be a factor. So above that, what do we have? Bullish order block. Mean threshold of the order block, that would be 1. Boom, there it is. You're trying to tell me that it's just this easy. Yeah. All right, so we have our level here. Draw that out on the Fibonacci 50% level. Now, the fib is doing no magic here. All it's doing is allowing me to show you graphically what half of a specific price range is. That's it. It's not doing anything other than that. I don't need to have the fib on there. I'm just showing you the precision behind all of this stuff. These are the things that I'm not doing and walking through every single time I do a video because you are supposed to be doing all these things. This is how you practice using everything I taught you. 50% level of the down close candle, which is a bullish order block in the low end of the premium to discount PD array matrix. We're in the 50% level down. Lower half of that range. What range, Michael? The unrealized dealing range from the daily chart. Remember the volume imbalance up here? That's where the draw is. The initial draw on liquidity. The market should reach up to that level. Okay? When the market drops down, it trades to the bullish order block here. You have a little bit of a rally. But look what it leaves there. Relative equal lows. Liquidity will be drawn from over here or something like that, where longs have now trailed their stop loss up here. So what kind of stop is going to be residing below these lows? Sell stops, protecting long positions. The market drops all the way down into mean threshold of the bullish order block. It upsets, it purges liquidity. IPTA drops down there and allows the sell side liquidity resting below these lows to flood the market with willing sellers to be selling at a low price. Market drives down aggressively. See how it does that? Hits it, they pair their orders. Now, will every bank trader from all banks be able to get on that move? No. No, not all the time. It doesn't work perfectly for them because there's some measure of human element there. Now, their trading algorithms that match up with IPTA, they are always being tweaked, okay? And they have the inside advantage because they know what IPTA is programmed to do. I don't have all the pieces. I have a lot, but I don't have all the pieces. I have enough that makes a killing, okay? No one's delivering what we do every single week. No one has this type of science in their analysis. It doesn't exist anywhere else, period. You can't get better than perfect. You can't. You cannot do it. What's the low of that candle? 97.195. What's the 50% level of that? 97.195. Hello? You paying attention? You awake? Am I boring you? You cannot get better than this. It doesn't exist. Okay? Blue shaded area. You're in a discount. Order block. What makes it a high probability order block? A fair value gap. Does it exist? Here's your candle high. Here's your candle low. The one candle in between. If it trades down and fills this one imbalance there, it does there. You can buy it there. Boom. Where will your stop loss be? It has to be below the recent swing low. That's here. So your stop loss will be down here. Would you get stopped out there? No. If it trades down there, should you freak out? No. What could you do? You can buy more. Well, wouldn't I be adding to a losing position? No, because you're trading near the low end of the dealing range that you're working within, and it's allowing you another opportunity to do what the bank traders are going to be doing. Accumulate long positions. Market trades down there. Does it stay down there long? No, just 2 hours. Boom, boom, and expands to the upside. Creates equal highs at what? The volume imbalance. So we can scale off something here. What do we do next? Here's the mean threshold of that bearish daily order block. Hits it up there 1, 2, 3, 4 times. Gives you an opportunity to get out at the mean threshold of the bearish order block on the daily chart. Now, I'm not stating that we are trading the dollar, but these are things that you're measuring against the bearishness of foreign currency. So, from a trading plan standpoint, when I say I think the market's going to not trade here, it's going to trade to a specific level, I'm telling you where it's going. Not every time I make a video, but when I tell you it's going to go here, it's going to go there, you hear it. You hear me say these things, okay? I'm not ambiguous about it. I'm not wishy-washy about it. I'm saying it's going to do this, and this is where the line in the sand, changes the context of what I just said to you, okay? So it gives you the entire framework. So you need to go into the market and trade your demo with these ideas and practice. Even if you can't do it live with a demo, go back and study the price action so you can see it. This is the homework aspect. This is how you roll your sleeves up and put the time in. You ever hear me talk about that? Of course I do. I say it all the time. The lazy people do not do this. If you are unwilling to do this, I ain't doing this. This is too much work. Quit. I want you to quit because it's not going to get easier. It's going to get harder. There's going to be so many things technically that need you to really just practice and study and practice and study. And it will take you years to get good at. Do you need that level of precision? No, you don't. But I have it. And I have so many other things. I can't teach it all one time in one video because it's so vast. It's deep. 27 years worth of this stuff. Okay? So just know that it's hard work here. Okay? It's hard. You're going to have to practice. That's why they call me the guru from hell. I got the #1 spot on Twitter when they did a poll. And guess what? I'm wearing that with honor because I am not like everyone else. There's nothing like this. So we have our objective. Well, I think that's, what is that? I forgot what that is. Let's go back to a daily chart real quick. I lost my, this is the buy-side liquidity pool, relative equal highs. So this would be our next level beyond the SIBI. So the SIBI exists throughout here up to this level here. So I'm expecting the market to want to convince me Monday and Tuesday that it still wants to do this. Now, it might drive up here based on the FOMC stuff. Okay, that might be where it goes. Okay, great. Who cares? I'm already positioned. I have a short position on Eurodollar. I've already taken 2 profit, 2 scalings. Done and dusted. 30 pips and 50 pips. I took 80 pips out of Euro. And I don't really care if it goes to where I think it may go, which we'll talk about in a moment when we get into Euro. But for now, just know that we have a repeating phenomenon based on the things that I taught you from month 1 content. Now, I don't know why I dropped down to the 15-minute time frame. I wasn't supposed to be there yet. So we had a run on sell side liquidity here. Price trades down, hits the mean threshold of the bullish order block, completely random level, rallies up. Then we have these relative equal highs. Now, these relative equal highs, the high comes in at 97.63. Okay, so let's calibrate that level. 97.63. What level are we really focusing on in there? Using a 5 level or a 0 level? Remember, the high is 63, 97.63. Calibrate it to 97.65 or 97.60. Your choice. Now, personally, if we're down, if we're coming from a low, working our way up, I'm going to do what? I'm going to use the low-hanging fruit method. I'm going to use the most easiest range to work within. I'm going to scale back. I'm going to roll back to 60. So if we have 60 is our calibrated level, not 65. You can say, well, it's over 62. How are you going to divide 5 pips? You really can't. So if we were trading at like 97.67, then I would say 97.65 then. But in this instance, I'm using 97.60. In my mind, that's the level they more or less worked here and left. What's 20 pips above that? What's 10 pips above that? What's 30 pips above it? Okay? We have 70 where we closed on Friday, and then the high is basically 80. There it is. You see how everything works in predetermined, very anticipatory patterns. It does this stuff all the time, every single day. That's why my tagline on Twitter is every week, every day, and it won't stop because I understand these things. Now, rewind, go back. Wednesday, prior to Wednesday, I didn't know. I didn't know what we were doing. And I said, there's really not a whole lot to talk about the previous weekend. And some of you are probably, oh man, this is bullcrap. Come on, ICT, you're better than this. I'm teaching you how to do these things. Wednesday, we got exactly what we wanted. We wanted to see one of those range barriers on the dealing range for the dollar give way. We didn't care if it was the buy side or the sell side. It gave us the buy side. That was displacement. That's here. Okay? Right in here is your opportunity to go long. Isn't this an optimal trade entry? Sure it is. Look at this low up to this high, draw a fib on it. I'm not going to do it because it's something for you to do. That's an optimal trade entry long there. Right in an optimal trade entry zone. I don't need a fib to do that, and certainly you shouldn't be needing it anymore. But you can see it, right? Now, it delivers right to the pipette. That means not even a full pip. It goes right to the full pipette of 97.19 and a half. Tell me where you see that anywhere else. Okay? You don't see that. No Traders Club anywhere has this. Period. So I'm a little bit on my high horse today because I'm going to be honest with you. And that tweet I saw today really offended me because I wanted to rip into it a little bit more, but it would have been very disrespectful on Chris's part because, like I said, I have a lot of respect for the guy. We've had lots of conversations before, and I don't want to have anyone take things that I say out of context and then bring heat between him and I, because I would hate to. That's just one guy I don't want to do it with, not because I'm fearful of anything. That's just we've never had a relationship that would warrant something like that. But I know there's a lot of people ripping him off, and I tell him all the time when I see certain people teaching his stuff, I'll push him and say, hey, look, check this out. This guy's either selling your stuff outright or he's teaching basically your stuff. So just know that I'm fired up today. Okay, I'm really, really fired up. This would have been probably a great day to be on YouTube and let everything rip, but I just... Sometimes I just want to pull the veil back and just show everybody stuff like this, just to remind them who is talking to them. But just know that you're here for a reason. You're here in the preferred seats. And as much as I see those things and it offends me, it also, when that rush dies down, as it's starting to do now, because we've been at 52 minutes mark now here, I'm dying down with the energy behind it all, and it's now more pleasing because they don't know. They do not know. They have no idea what we talk about here. None. And you should be thankful for that. You're here learning about something that people just don't know about. They don't know it, okay? And sometimes I question whether or not do I want to continue doing this? Do I want to, put all this stuff out there? And I'm reminded that, I was blessed to receive this, and my promise was if the Lord was allowing me to learn this, then I was going to share it with all of those individuals that be willing to learn it. So here we are. Okay, so look at the order flow once the market shows a reaction. It wants to go higher, great. Okay, the market comes back down, finds some support, rallies again, fair value gap, trades into fair value gap, rallies again, fair value gap, order block, trades down an order block, fair value gap is closed, expansion on the upside. Is order flow bullish? Yes. Okay. Now, segue into, let's put the daily dividers on here real quick. Here's Thursday's trading. That's the only day at the earliest that we could have done anything based on the information I gave on Wednesday. Then on Friday. Okay, so again, we were pulling out this level here, the SIBI. The only level I didn't have on, or even mentioned that I can think of, was the mean threshold of the bearish order block. But you know that anyway. I shouldn't have to tell you about that one. But that's a premium array. In other words, it's where the market will seek, if they will want to go up there, and offer that price. And that's all that it did for 4 hours. Now, we're going to take this information and segue right into Euro. All right. So here we are. We have Euro. And obviously, everything you see here should be... What, you don't recognize this? This is naked trading, man. Look at that. That's a naked chart. That's rated R. Or is it rated X? Which is it? I don't know. I think it's rated. This is naked charting. It's funny when you think about it like that. All right, so we have our daily dividers on here, and right away, everything should be popping off at your perspective. Everything should be lining up. All your focal points, your eye should be going right to it right now. If it does not, okay, if it doesn't happen for you right now, it's okay. It will happen in time. But we're going to put some lipstick on this, add some perspective. All right, so here is our chart with all of the ICT goodies. Okay, everything that I teach you in the mentorship is here. Okay. On Thursday, go back and look at the economic calendar. We had a lot of ECB, news events coming out. What I want to draw your attention to is we had a very clear, obvious level that would need to be rated on Wednesday. Go back and watch Wednesday's video, and you'll hear me talk about how we're waiting for premium arrays, fair value gaps, bearish breakers, bearish order blocks. Okay, I'm prompting you to look for these things, and I purposely stayed off of the lower time frame charts because I know that some of you take this serious and you want to go through the charts and you want to do the work that's needed, and the lazy folks are just waiting for me to talk about it and then get mad because I didn't tell you beforehand. But I did tell you beforehand. Okay? Remember that whole month one content? The context behind all that? Remember that? Framing high probability, low resistance liquidity runs. Okay? If we go back to, here is Friday, Thursday, Wednesday, Tuesday, Monday. I'm going to take the fib and drop it on top of the high of the week on Monday, all the way down to this run on this low. Now the low I have here is 111.06 and 9 pipettes according to this data feed. Also, real quick, I got a couple emails from folks asking what's up with my demo account and what demo am I using. I'm using Ava, okay, but it's Ava Demo 1 MT5. Okay, that's what it's telling me in the upper left-hand corner. So Ava Demo 1, I guess that's the server. I think originally when I started with them, it was Ava Demo 2. Yeah, Ava Demo 2. But it expired on me, and I already told you about all that. They initially told me, they said, the people that were telling me about Ava, it never expired. It did for me. Either that or they realized I was out of the States, or in the States, and I was outside of their service region. And yes, I'm aware some of you also sent me this email as well, so I'm kind of answering that as well. The way I got Ava demo account is I went onto a website for real estate for Bermuda, and I just simply grabbed an existing phone number and used that as a way of setting up the demo. Every time I open up a demo, I always put some falsified information on there because, well, think about it. Wouldn't anybody want to know what demo account I'm using? So I purposely don't ever give them my email. I don't give them nothing. I don't give any kind of information like that could lead back to me. So anyway, that may be the reason why some of your data looks a little bit different from mine, but Ava Demo 2 was what I had initially, and now they set me up with Ava Demo 1. Okay, so later on in the content, when you're going through the mentorship, you'll hear me talk about things about how when you get into live trading, you'll see that there are servers that they put you on, like FXCM, which I'm glad they got crushed and no longer allowed to do it in the States. But I would never trade with FXCM. I don't usually talk about brokers. I don't ever advise people to go with specific brokers, but I will always bash a broker when they don't deserve it or deserve the business people give them. FXCM, you should never trade with these jokers. Okay, they have so many servers. Think about it. Why would a broker put you in one server and other people in a different server? Isn't price offered the same way? I mean, sure, it's electronic. We can't afford to let you in here because it's too crowded. Come on. They put you in these multiple servers because the delivery of price is going to be manipulated to suit them. Okay? Now, every broker to some degree is going to work within this model because it's allowed. That's why it's very, very difficult. That's also why I teach you the low-hanging fruit, because you are going to use the least point of resistance and you're going to get out at the first opportunity 10 or 20, 15 pips before your ultimate target because of that spread that they're going to use across their servers. Now it's starting to make sense. You thought it was just because I wasn't trying to show you I was really that precise. No, I am beating these guys, okay? I am beating the collars off of them, but I need to work within a range that is high probability. So I want to be getting out when it's moving in my favor and it's scaled to a specific price range. 20, 15, and 10 pips before I get to my target, I'm already out. Because many times in live trading, I did not get my limit orders tagged, but I could see on every other feed, it went there. So that's the funny money games that take place. Now, again, you can get mad and say, oh, this is bull crap. You're never going to win this because it's rigged. I already told you it's rigged. I told you that in the free tutorials. But there's a way to beat it, and you have to listen to all the things I talk about. Okay? But anyway, I'm going off on a tangent here. Monday's high down to the low on Thursday. I need to see the market trade above 50%. Then we're in a premium. We're in a premium market. Fair value gap. Bearish order block. Buy side liquidity pool. Liquidity void. What's the difference between a liquidity void and a fair value gap? A fair value gap is one singular candle where there's only one side of the market offered, down or up. A liquidity void is a series of candles that have pockets in it. Look real close. We have this candle's high and the previous candle low here. This one single candle here, that is a fair value gap. But if we take this entire daily, oh not daily, but this 15-minute candle here, and this candle here, and this candle here, all these down candles represent a liquidity void. There's several pockets of porous price action in there where there's multiple fair value gaps. Okay, fair value gap is a singular candle event. Liquidity void is a multi-candle event. You will not hear Chris Lurie tell you that. Okay, it's not explained that way. Trust me, and it's not because I'm trying to teach his stuff. I'm trying to also differentiate myself from the folks that think I'm teaching his stuff. And honestly, like I've said in the mentorship before, liquidity voids was a label that I thought it was actually a pretty good description. Did he coin that? I don't know. But I know that prior to that, it was always called a price vacuum. Okay, back in the 80s, there was a guy that was teaching S&P trading, and his description was a price vacuum, and he came from the floor. So this was an ex-floor trader. He looked at the charts before he went to work. He knew where these things existed. They referred to them as a price vacuum. Now, that is a liquidity void, the same thing. It's just the same thing. Now, it's not that I'm teaching that guy's stuff either. He's not a formal educator. He was a one-on-one. I paid money for him to sit down and explain things to me. These are all, like I said, these are people that you're never going to meet, but they are really the inside loop. So I know what the floor traders used to do and how they work their numbers. Okay? These things that exist in my content, I've already told you if there's an origin, where it came from. If I tell you it's my stuff, it's my stuff. Okay? It's as simple as that. There is no fair value gap prior to me. It's just me. Okay? I just really want to beat this down and know that you understand this, because I'm not going to publicly defend myself every single time some goober goes on Twitter or Facebook or YouTube or whatever they want to do, okay, and talk about how these aren't my concepts, because they are. They're absolutely all mine. Okay, so for 20-some years, I've been doing this. No one has been able to see what I've been doing until I started talking about it. And the people that paid one-on-one to be with me. Above that 50 level here, that sends us into a premium market. Now, think about this. When this thing was screaming up, I guarantee you, everybody in social media, and I haven't had the time or luxury to go and look and see what the sentiment was at the time, but I'm quite positive that everybody was really bullish there. So I was looking at, in here, there was a bearish order block, and we were above the 50 level, and I already knew that we had a buy-side liquidity pool here and a void that could have been resolved or rebalanced to any spike up here. So my initial stop loss was factoring that in, but I didn't believe we'd go above this high here. And the reason why is because there was nothing really inefficient above it to the left. So I felt that we would get above 50, get up into a level of a premium, and then they would not see 112. They would defend 112. Remember that weekly BISI, buy-side imbalance, sell-side inefficiency that we've talked about for months now with the euro-dollar. I believe that's what this whole run here was setting up for. Now, initially, it starts off with a consolidation, buy-side liquidity pool, so there's buy stops above here. They want to sell them to those buy stops. So they initially set positions in here, sold here, sink it lower, bump the old daily low on May 23rd. Now, I got this fib. It's already done its job, so I'm going to remove that so we can look at the chart clearly. So we had this initial drop here. That offered pips to you right there. Think about it. I mean, there's pips available. 30-something just with that run there. Running the previous buy-side liquidity pool, too clean. Bump it. Run down to the daily low. Now watch. This is where it gets interesting. During the ECB-related news event, this highlighted area here, okay, is 111.06 and 9 pipettes. That is the daily low on May 23rd, okay? Notice how shallow that run was. We have this candle's low coming in at 111 even, okay, 111 big figure. They sold this to them, hook, line, and sinker, that 111 was support. They shallow ran the old low on May 23rd. So now what are they going to do? I can't recall, and the folks that's been here for a while, you'll remember this. If the date is something you guys can share with me, that way I can say, yeah, that's the one. You can send it to me by a tweet. Just tell me what day this was. You'll know what I'm talking about. But it was a setup around the dollar yen. And this is why I know I remembered it, because I don't usually talk about yen. But yen does this stuff all the time, where they take it down to an old low, very, very shallow run, and then they pump it up real quick, okay? What IPTA is doing is allowing them to get a larger portion of their short on that they couldn't have done here. It was too fast, okay, because IPTA works off of time and price. Look how much time in these candles, okay, that IPTA allowed and offered all this range of being short, absorbing all the buy-side liquidity pool, and selling a narrative that this was a support level. So I went right in there and sold short on the first premium array, which gave me 111.67.6 or 9, something like that. Right off the top of my head, I can't remember, but you can see the tweet I recorded. So I knew that a 30 pip stop loss would be sufficient enough to support that trade and not worry about babysitting it, because I wanted to meet the challenge. I'll take one trade for the week and get 30 pips. You know, hit or miss. That was the previous week's challenge. And as it was screaming up into there, you guys can see it. I showed my sales time and price with the fill on the Twitter feed. And no, I will not share who that broker is I'm using, so don't ask me, because I won't be doing that for obvious reasons. So the rejection in here, all I was waiting for was to come back down and look right in here. Right in here. What do you see? We have the low to the high. Split that in half. Okay, split that in half. Let me just do it. Why don't you just put the fib on there, Michael, and stop talking about it? Just do it. See, I know what you're thinking. Now just drop that fib. I can't catch it now. There it is. All right, so there's the high. There's the 50 level. Okay, so when price drops below that, now we are back down in a discount array. Or I'm sorry, we're in a discount market. So we can trade off of a discount array if the context is bullish. Is the context bullish? Absolutely not. Remember, this is Thursday's trading. I said dollar was going where? Higher. So just because we go down to a discount array, and it may trade down and close a liquidity void, or it may trade into a bullish order block or something like that, it doesn't mean it's a buy. They are going to act as targets for shorts. So price comes down here and then consolidates right around that 50 level. You see that? Using the flout, I had a calibration and projection on the standard deviation to 111, 11, and 7 pipettes. The low, let me see here. The low comes in at 111 and 5 pipettes. And this low, I think that was actually the low. Nope. It was 19. So I was only off by, what was that, 2 pips? 2 pipettes, I think it is. If I got this right. Yeah, I was only off by 2 pipettes. So not even a half a pip I was off using the flout. Okay, the flout on Thursday gave me a projection that we could see as much as 111.87 and 1 pipettes. And the high, if I can get it to pop up here, 111.87. No, sorry, yeah, 111.87 and 1 pipette. That's the exact high. Again, you cannot do outside of perfect any better than this. It's it. It's that perfect, folks. It's perfect. 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 You can't get better than that. Okay? Stop looking. Stop bouncing around, looking for the next hot thing. There's nothing better than what you're learning. Period. Premium array. Okay? Premium array. Go short there. Why? Because we're in the midpoint of the weekly range and the dollar is bullish. This is all fake. This is all phony baloney, just noise. Get everybody excited. A lot of speed in there. Looked real convincing, didn't it? Now we have this range, the 50% level below. We want to start stripping down the market and looking for our discount rates for targets. Remember, I'm holding a short up here. Once I got 30 pips, I took a portion off. Really small portion because I wanted to see it come back down 50 pips. And we had the initial low here. I was looking for a sweep below that. So there is a discount array with this old low. We also have this area right in here. Fair value gap. One single candle. Let me take the fib off because it's probably confusing you too. Right in here. One single candle up. And the next candle is low here. So that's a fair value gap. And we have the bullish order block. Okay, you see that? Inside this down candle, let's zoom in. Here's our down close candle, or bullish order block. We'll take our fib and get our mean threshold. Drag it up here on the body of the candle. The wick is errant price action. So right here, we're going to take our... Good grief, man. There you go. I'll just use this horizontal line to denote this 50 level. So basically 111, 11 and a half. Okay. That's the level that would be a target. So if price trades there, I want to be collapsing the portion of the trade and then capture 50 pips. And the low on this candle comes in at 111, 11 and 5 pipettes. Are you listening? Seriously, are you paying attention? How many of you want to quit? Raise your hand right now if you want to quit. Come on. I mean, seriously, folks. You can't find this anywhere. It doesn't get any better than that. Everything is stripped down into a specific price point. It's not ranges. It's not ambiguous zones. It's none of that nonsense. It's a very specific price level that we look for. But there's a series of them that we have to operate within for targeting. That is the PD array matrix. But they're in logical order. Now, there may not have been a fair value gap in here, okay? There may not have been that. It may have been just simply one candle that ran all the way up here, and that would be a void. Still dealt the same way. But if we have a specific measurement that we anticipate seeing in price, relative, like for instance the dollar index, we have that unrealized dealing range. Well, when that comes to fruition here, we trade there, and then we start to consolidate, and we get another run higher, we should see the euro do the same thing, and it does. That's why I was holding on to the short on euro. Because of Friday, I wanted to take 50 off and then leave a portion on over the weekend. I rarely do that anymore. It's been years that I've held over the weekend because it's just weird lately. Volatile, just stuff happening all the time. And this instance, because of what I've outlined for you, this is why I felt confident holding a portion on. Not to mention I have 2 scalings on the trade, and I'm sitting pretty as far as I'm concerned. Here's that shallow sweep on the liquidity, and now we reject a sweep on buy-side liquidity. That's here. It does it to a premium market, right to the pip, runs buy-side liquidity pool, fair value gap. This was an area where you could have taken a short in as well. A 30 pip stop loss on the trade, handled perfectly, no issues. Scrunch down a little bit, and you'll see that weekly BISI rebalances at 110.20. So pull up your weekly chart, and you'll see what that level is. And you just look at the old videos too. It's all there. All right, so that's that for that one. Here's cable. Obviously, everything looks familiar here, doesn't it? I know, I'm being facetious. All right, so let's put our lipstick on. All right, so here is our British pound market. All right, so Friday. Remember on Wednesday, I wasn't really comfortable doing anything with cable. I felt that the lines and levels for euro were better. That actually changed on Friday intraday. We had a nice fair value gap in here. Price trades back up. Bearish order block, fair value gap, high probability, trades to the pip, sells off, creates another liquidity imbalance, fair value gap, rebalances, boom, sells off, bearish order block, fair value gap, rebalances, sells off, boom. Okay, the low here, July 17th low, that's what it does, a shallow run below, kind of like similar to what we saw on the euro dollar. I don't think that we'll see a big run up here. I think it's probably just going to just stay heavy and roll down. But if it does pop up, just be mindful of this little one in here. I think that would probably be sufficient enough. It's also really close to this low here, so in close proximity, this void may need to reclose at around 124.20 to 124.15. I don't personally think that's going to happen, but should it get up there, I'll be interested to see anything live at the time during the kill zone that could provide me an area to sell short. Otherwise, it's probably just going to stay heavy and roll over. And 123 even is my swing objective for that one. And everything in here, you can see that we had a work of 125 big figure. Nice spike up here. Worked that level. Consolidated using flout. 125.16 is 10 pips above these highs here. So we essentially did a 10 pip run above liquidity here. Right to the pip on Wednesday, or even to the pip at actually. The high comes in at, actually I was off by 4 pipettes. I'm really giving myself too much credit there, aren't I? Still close enough for government work nonetheless. We do have a 24.17, 4 pipettes low of the week, and I think I was off 3 pipettes there too. You can see a little bit of a tail below that one. And 124.55 and the low one here, off by 1 pipette. So you can see it's really tight. So again, when we're using the standard deviations like this, we use a 5 pip range where we allow for I guess the words that's actually escaping me. I've said it many times in the past, but I think I've just talked myself into fatigue now because we're at 1 hour and 20 minutes now. But we allow for 5 pips to variance. Okay, so the July 17th low was a shallow run below that. I don't think that it needs to come up here, but if it does, I would personally be looking to practice as a short in here, and then again look for that 123 big figure. 123.20 is where I would like to personally get out myself, but 123 big figure I think is where it may want to reach. Okay, and I think that's going to be it, folks. I will talk with you all by way of the forum on Monday and Tuesday, should there be anything. And then Wednesday, like I said, have expectations very, very low because we'll not be doing anything the rest of the week by then. So we're looking for, in bottom lining it, we're looking for a continuation lower on cable, continuation lower on euro, higher prices on the dollar index. And again, that's that buy-side liquidity pool. So we're looking for a run up here. If we get above this level here, be mindful that we could see a pretty significant short covering rally in these foreign currencies here. Okay, so that's the skinny for right now. I will catch up with you guys by way of, again, posts to the news section or thread. All right, folks, that's going to be it. So until I talk to you next week, I wish you good luck and good trading. Enjoy the rest of your weekend.